All right, let's dive into the fast-paced, high-stakes world of futures trading. And we're going to do it by looking at one of the most important commodities on the entire planet, crude oil. Now, this is a market where, sure, an airline might be trying to lock in its fuel costs for the future, but it's also where traders are betting millions on which way the price will move, often without ever planning to see a single drop of actual oil. So that brings us to the big question, right? How on earth do you trade 1,000 barrels of oil without actually buying any of it? It sounds kind of like a riddle, but the answer is the key to how this whole market works. See, it's not about owning the physical stuff, it's all about controlling a contract that represents its value. Let's unpack how that's even possible. Okay, to really get this, let's put ourselves in the shoes of a trader. This person has been watching the markets, they've been reading the news, and they've got a gut feeling, a strong opinion. The price of crude oil is about to go up. So what do? They decide to act on it by buying a crude oil futures contract. This is their $80,000 idea. So at the exact moment our trader makes their move, let's say the market price for 1 barrel of crude oil is $80. Simple enough. That number is the starting point for everything that comes next. But here's where things get really interesting. Our trader isn't just betting on one little barrel. No way. A standard crude oil futures contract, well, that represents 1,000 barrels of oil. It's this scale that gives the contract all its power. So let's do the quick math together. $80 per barrel times 1,000 barrels, and that brings us to $80,000. That is the total value of the oil that our trader now controls with just one single contract. That's some serious exposure to the oil market. And this right here leads to the most important question of all. To control $80,000 worth of oil, does our trader really need to have 80 grand in cash just sitting in their account? I mean, if they did, this would be a game only for the wealthiest people out there. But the answer is a definite no. Not even close. And this is where we get into the real mechanics of what makes futures trading so powerful and, so risky. We're talking about the magic of leverage. So instead of the full $80,000, our trader only needs to put up about $6,000. Yeah, that's it. That relatively small amount of money is all it takes to open the trade and control that entire $80,000 position. Now that $6,000 has a special name. It's called margin. And the best way to think about it is like a good faith deposit. It's not a down payment on the oil itself. It's more like collateral that you post with your broker to show you can cover any potential losses. It's basically the key that unlocks that huge $80,000 position. And this right here perfectly explains the whole idea of leverage. Leverage is the power that margin gives you. In our example, the trader is using their $6,000 to control an asset worth over 13 times that amount. What that means is that any little change in the price of oil is going to be massively magnified in their account. Which, of course, brings us to the two-sided point of futures trading. This incredible power to amplify your returns, well, it works in both directions. It can create amazing profits from tiny market moves, but it can also hand you some devastating losses just as fast. Let's just break down the numbers here. Because the contract controls 1,000 barrels, for every single dollar that the price of oil moves up or down, the value of our trader's position changes by $1,000. A small ripple in the global market becomes a massive wave in their trading account. So let's see what this actually looks like. If our trader is right and the price of oil jumps by just $2, boom, they've just made $2,000. That's a huge 33% return on their $6,000 margin. But if they're wrong and the price drops by that same $2, they lose $2,000. Just like that, a third of their capital is gone. That's the cold, hard reality of leverage. And if those losses keep getting bigger, the broker's going to step in with something called a margin call. And believe me, this isn't a friendly request. It's an urgent demand for more money to cover those losses. If the trader can't come up with the cash, the broker will just close the trade for them, locking in the loss. It's a safety measure that protects everyone involved. So we've walked through the highs and the lows of a single trade. Now let's just zoom out for a second and look at the general playbook, the basic framework that pretty much all futures traders use. It pretty much boils down to 5 steps. First, you've got to pick a contract that fits what you think the market's going to do. Second, you really need to understand the contract details, like how big is it and when does it expire. Third, you deposit that required margin. Fourth, and this is absolutely critical, you have to monitor your position and the news constantly, because things can change in a heartbeat. And finally, before that contract expires, you have to decide, do you close the trade and take your profit or loss, or do you roll it to a new contract to keep your position open? At the end of the day, futures trading is really a story about leverage.
It is a financial tool that can build wealth faster than almost anything else, but it has an equal, opposite power to destroy it just as quickly. This is a force that demands discipline, it demands risk management, and most of all, it demands respect. So the question isn't just about whether you can win, it's, do you truly respect the risk?